Top Picks is brought to you by Questrade, where you can trade stocks from 1 cent and buy ETFs for free.
And we have those top picks here with David Burrows. We're starting with Morgan Stanley. How come?
So when you look at what's happened in the financial sector, you had this rebuild of capital coming out of the 2008-9 period. A lot of regulation that forced them to take a lot of risky activities out, like some of their heavy trading operations. And then you had a lot of litigation. So there's been a lot of clouds hanging over the financial sector. Morgan Stanley is an interesting company because they are moving very actively toward their area of competency, which is asset management and wealth management, which makes up, about 55% of their revenue. So this is a very stable business. They deal with a very high-end client. If you believe market environment continues to improve, their asset growth should be strong, and their return on equity should be getting better. Because they've been held back on paying dividends, we think that their dividend could go up like 100 or 150% over the next 2 years, which is from a low level to begin with, but you're going to see accelerated dividend growth. And we want to own the companies that benefit in a stronger market environment. We believe investors will be prepared to pay a higher multiple of earnings as they recognize that the risk level in these businesses, like a Goldman Sachs or Morgan Stanley, have come down dramatically due to the new regulations.
You're also recommending Electronic Arts. Is this a long-term investment or more of a trade?
No, we are invested in many areas that are affected by consumer health. And, certainly as the price of oil has come down and as financing costs have come down and as inflation has come down, the consumer has more money in their pocket. And we all have heard the term, this has been like a big tax cut. Well, EA has a very broad range of customers, from young folks to people who are a lot older, a lot of the gamers. And what's interesting is, as the consumer's stronger, they'll spend a little bit more money on things like gaming. But they're going through a sea change in their business model where so many more of their sales are being done online, where they cut out a retailer. Mm-hmm. So their margins are growing. They're in the third year of the 2 new game consoles, which tends to be the strongest year for sales for software. They've got a customer that is a repeat customer, constantly upgrading their games. And so this is a way to be exposed to a consumer in an area of secular growth where there's a catalyst, their business model is changing and their margins are expanding.
Looks like an all-time high today as well on EA. Speaking of consumers, that's who Disney targets.
Yeah, and by the way, you should never be afraid to pay a new high for the stock. It means all the shareholders are happy and things are firing on all cylinders. We've talked about Disney before. One of the first places people spend money when they've got more is on travel. Certainly their theme park business is doing well. They've got catalysts coming up this year. We know China's slow, but they're trying to increase their consumer sector. They're opening a new theme park in Shanghai. They've got a number of movies coming down the pipe. Certainly the next movie in the Star Wars franchise is coming. So their media businesses are doing well. ESPN's doing well. And again, consumer-based. You're going to get 15% dividend growth going forward. Very, very strong balance sheet. This is a company that is likely to win in a better environment.
Walt Disney, Electronic Arts, Morgan Stanley, top picks of David Burrows. Great stuff. Good to see you, sir.
Thanks very much for having me, Mark.
All right, David Burrows, our thanks to him. Thanks for your questions. Stay tuned now for Catherine Murray and Business Day PM.